and his superpower is the asset management. So that's why he's hyper focused in Houston area, because you want to play with the asset management portion of it. So thanks everybody. Again, this is Shariah on behalf of Massive Capital, and so Mike is on the road. And as I get started, agenda for today, just a little bit about Massive Capital, and then we'll talk about the business strategy and the market update, and then how that rolls into our underwriting. We're going to use a case study where we looked at an asset, we made an offer, we lost it, we're happy we lost it, it came back out, but still it is active. I will use some fictitious number because it's an active deal. And I believe I have two of my friends here on the call. They're also making offers. So at least here, my goal is to share how we go about underwriting and underwriting the property, and both from the qualitative and the quantitative perspective, and how the business strategy and the market update factors into our pricing. Then we'll open up 20 minutes for Q&A. So we're 10 minutes into it, 11 minutes into it. So next couple of sections, I'm gonna go really, really quick. Then again, if you guys have any question, please drop a note on the chat. I believe we're gonna record that as well. So if you have anything, just let us know. And Jasmine, and I believe we have Ramesh, and we'll be taking notes as we go. Okay. So Massive Capital, we have 4 partners. This is me, I'm Shariah, oil and gas, corporate, Shell, in sabbatical. So that's my corporate background, 14 years with Shell, first 6 as an engineer, everything minus the chemistry, downstream manufacturing, the refinery. Pasadena was my stomping ground for 6 years. Then I went to Rice, got my MBA, went to the finance organization, business planning, strategy, portfolio. And that has been my expertise on the finance side. At my last role, I was the business finance perspective. I was the business transformation manager, looking at what a $23 billion portfolio, reporting to the CFO of the business. For any oil and gas, that is the Shell global deepwater portfolio from the upstream. So I worked in upstream, unconventional upstream, deepwater portfolio, and also on the integrated gas a little bit. So I have a decent amount of value, understanding about the whole value chain about the business. And this is on the residential side of it. On the startup side of it, I started 3 companies before we started Massive. So first one was a failure, second one was a break even, third one I still have it, and Ramesh is a part of it, and the fourth one is the Massive Capital. And part of my fun job, I used to moderate the Rice business plan competition, the final segment of it. So it's amazing to see how the VCs, a room full of VCs, will beat down the top 10 companies and how they get funded. So it was an interesting one. My partner Ajit, I've been working with him for the last 3 years. He has been my partner for 100% of my commercial deals. That's where I started. He used to be my hard money lender. Then he became my friend. Then he became my partner. And I leverage on him, on his expertise on the commercial side. He's a CPA, UTMBA, and also comes from the hotel background. Sanjay, I believe he's not here. He is a good friend of Ajit on a different platform. So they work together. I heard about Sanjay. I knew about Sanjay. Same mechanical engineer, then went to finance after doing his MBA from Chicago, Booth, Barclays, expat, then full-time multifamily since 2016, I believe. So he flipped about 9. What's up?
Oh, jeez. Oh, shoot, sorry.
No problem. So we have, he did full cycle about 9 assets, but his full focus now on the multifamily side of it. So he brings the expertise on the apartment side. And I believe he worked with one of core player of the big dog organization with MassiveÂ. So he has seen quite a bit as well. So he was our bolt-on skill set for all things multifamily, especially operations, which is also why he works as CEO of Massive. Ajit looks at the new development, all the new developments that we do, and I look at the financial CFO and the strategy. Then we have Mike. Mike, would you like to introduce or should I go? You tell me. Mike is like, I'm driving. So Mike knew Ajit for a long time. He knew Sanjay for a long time. And as you know, he's an expat, ConocoPhillips. And he has been, I think, expat for 22 years across, I don't know, more than 15 countries, came back to US 5 years ago. He retired 2 years now. and then went to multifamily full time. Him by himself, inclusive of Massive, less than 12 months. Last 12 months, he did, I believe, 14 or 15 assets, total $80 million assets. So put together, when we came together, all of us, we played solo. Just think about us by ourselves, bought about 400 properties last 5 years, but we decided to build a company that that we can grow at some point, not a typical retail syndication, one, then a two. We decided to build a company where we wanted to build a C-level team that can run $250 million of the asset under management. So that's that. Behind us, we have some fantastic junior partners, associates. Jasmine, you want to go a little bit by yourself? You want to move?
All right. Yeah. Yeah. Hello, everybody. My name is Jasmine. I've been in several industries, just mainly doing my entrepreneur journey. I joined Massive Capital this year. I've been in real estate for the last 3 years, but this is my first year in multifamily. So I'm excited to be here. And I do investor relations for Massive Capital and everything else that they need.
Thank you, Jasmine. This is awesome to have you. And guess what? She's also been a co-sponsor of 100 plus units. So she's an active investor on the GP side. She manages two of the assets as well. So thank you. And so we have Candice. She's not here. She also does investor relations. She has her own businesses, and she's coming into the apartments multifamily sector with us. We have Bhaskar. He's a junior finance manager for Massive. He does all things underwriting. The first pass, he does it. He's a solid FP&A background, CPA. He's in India, used to work for Shell with me. Then he became an expat to Dubai. Then he went back to India and working with us since earlier this year. Last but not the least, we have the firepower, Ramiz. Where are you, buddy? You want to talk a little bit? Introduce real quick.
Yeah, sure. Hey, everyone. My name is Ramiz. I've been into business almost for like 10 years now. I kind of just started off flipping small things, ordering shoes and just selling them. I got into marketing like 5 years ago, and I started a few companies. Some of them succeeded, some of them broke even, most of them failed. But I got into real estate around 3 to 4 years ago with Shariar, with the other side of the business. I've done around 200 plus deals for single family and land deals. I just joined Massive Capital around a year ago, and I'm super excited to work with everyone and work together and see how, we can all make some money.
Thanks, Ramiz. So my tagline for Ramiz is a pretty new car in the block, but has a lot of mileage. He's a young guy, but that has done over 200 closings. That's quite a bit. Thanks, Ramiz. So behind us, we have two more advisors, right? And we just can't go blind at it. So we have Paul Singh on the left. He has been a fantastic friend and a mentor and a sponsor of Massive Team. He comes from medical industry. He used to be a brain and neck surgeon, retired, I believe, last year. He started his real estate company 20 some years ago up north. Now he's moving down south, and we bolted with him as well. So he brings the advisory and the know-how and a lot of the balance sheets and the network plus the lender negotiating. He works quite heavily with Ajit for all new developments that we have. We have two brand new developments in the pipeline and two more that is under contract. Sorry, one we already purchased the land, other one is under contract, and we have two more in the pipeline. So Paul is helping us on that. On right, we have Ash. He is, again, a great friend and a great sponsor of our team. I believe he's in 58 active deals. He took on over $1.23 billion worth of loans. And so he knows his network is extensive across all these states that we work in. So put together, we felt like we're a good team. And that's how we started Massive. Here we are. A couple of things, I'll go kind of sort of quickly, but just to kind of, the top portion of it, our goal that we provide a comprehensive end-to-end value add for our partners across all the value channels, deal sourcing, underwriting, equity, balance sheet, asset management know-how, and everything else. So our goal, if you ask me, it's our really goal is to enable our partners. So this year, YTD, we have made 13 people first time as a GP into the multifamily. Mike beat me to it. There are 5 brand new people partner with me, and they became GP for the first time, and Mike did 7. So Mike, kudos, buddy. So our goal is to do about 10 to 20 general partners a year, brand new, and then accelerate them as you go. We partner with local operators, and we help them grow and help them build their operating muscle by reducing the equity and debt. And that's how we partner with Al. We met Al. Al sits in Brad Shamrock's platform. We also sit into Brad Shamrock's platform. And when we looked at this case study that I'll talk about it, we felt like he was very clear about he wants to focus in Houston. He wants to be an operator, and our role is to we come in, we bring in debt and equity, and also the negotiating, so we can accelerate his growth. We also work with equity partners to bring them deals for us to invest in, so we kind of sort of reduce the time about deal sourcing and due diligence and asset management. For us, we tend to partner with folks who has clarity about what they want to do. And typically when a team wants to do everything about everything, is too independent, it doesn't quite work, right? And that's our core focus. All the deals that we have done, about 82% of our deals that we have done with our partners, and we are partners heavy. So we'll talk about it as we go. Value chain. So this is how we manage the value chain, the deal flow, the contract to close, equity, investor relations, asset management. We provide support across any of all the buckets. So this is how we partner. So we almost shelletized, almost corporatized the framework. So hey, if a partner comes in, we kind of go through this slide. We ask partner, what do you need from here, and how can we add value? From the deal flow, we have our own network. We have our marketing stuff, initial screening, our underwriting. We have 1.5 FTE, full-time employee that all they do underwrite. We have good relationship with lenders. We have bring in base debt, pref check, or anything like that, depending on how that goes. And we have right now, after doing 8 deals this year, we have a decent amount of process ready. So I went through quick, so I'll stop there. Then I'll go to second section, which is the business strategy and market update. So just to let you know, for us right now, as you look at the business strategy, one thing to kind of give an example, we have a deal tracker. Right now, we have 8 closed property. We underwrote 88 properties. When we say archive, that means we offered on 88, we made offers on 88 properties in the last 4 months. And we have total about 20 in the pipeline that we're actively managing. So our goal for the MassiveÂ team is to have 2 to 4 contracts every single month at a continuous basis, about 3 to 4 LOIs or offers pending at all time, and 5 or 6 that initial underwriting is happening. So our deal flow is pretty heavy. That's because we have a team. That's because we have great partnership with our partners, and we have our network. And so that's how we kind of go about it. For us, market matters, asset size matters, asset class matters, deal sourcing matters. And anytime we have a business tactic, for us, we do know one thing, that we're not doing something new. We just have to test the hypothesis of all the investment cases, then we go. So we look at every single thing very tactfully. All in all, we're in 6 markets. We have closed, we have 2 properties here in March. We closed 1 in June, and then July, then September. This one, the land was next to our this is going to be a $20 million project coming up. We're going through the design process, and then we just closed the Macon, Georgia 2 portfolio, and then also Water's Edge. And with the local team, the same seller of the Water's Edge has another property, which is the Haymount, that went under contract yesterday. And we also have 4.5 acres under contract in the Energy Corridor for 270 units, Class A new development. And those are the markets that we're in. Now, things that I would like to point out, that as a brand new team, almost like a startup, 10 months into the game, we are kind of sort of nods and nerds. We're academic buyers, and I'll explain how I why we say academic. And then that's why we did a lot of internal study. We have an internal proprietary ways to take a look at the market. And those are the markets that we feel good about. And we have boots on the ground. We have local partners. We have actual data set. And we went into all those markets simultaneously. And we're actively looking for partners in Florida market and in Arizona market. So that's the YTD performance for now. And again, as you know, there are 4 other offers pending on top of this. So I think I caught up. So I'll take a pause. If you guys have any questions, please drop a note on the chat box, and I'm happy to take it from there. Right? Okay, so let's go with the case study. So full disclaimer: this is an active property on the market, and it came on the market about 4 months ago. We took a look at it. We made an offer, and then we lost the property. But we were comfortable at our spot, comfortable losing it, then contract fell up, it's back on the market. Fictitious or closer to the truth, not exactly. But when we do underwrite, we categorize the way our approach is. We don't buy properties, we buy companies. 10, 15, 20, $30 million companies, $50 million companies, and each
You're cutting off, sure.
the company that we buy, we hire the C-level team. Intentionally, they should have the know-how of doing so. Because $10 million company, which is, am I back?
Yes, we can hear you better now, but before it was cutting off a bit.
Cool, awesome, thank you. Oh, sorry. So back to the underwriting process, that when we buy assets, for us, we tend to look at that we buy risks. So almost like we buy companies, and those are the 3 segments that we take a look at it. Market risk, the top-down approach, which is almost everybody knows. Look at the macro, look at the interest rate, look at the multifamily life cycle, and understand the relative positioning of as is today and how that's going to play out for the exit, right? Then we also look at the location risk, which is the bottoms up. We look at the city, the county, the zip code, and understand the characteristics of that strip that we're going to buy the property. And then we apply that our own understanding of the location. Just an example, one of our biggest thing that we have that we don't buy, and or our partners do not have properties. Because if I'm in Houston and someone is in Dallas, we're going to Seattle trying to buy a new property where both of us were new. So a lot of new thing happens. So let me see. All right, I changed the Wi-Fi from my house and hopefully I'm back. Okay. Jasmine, is it better? If you don't mind.
Yeah, it's better now.
Okay, cool. Thank you. So we, one of our core things as we buy property, we don't buy any assets where ours and our partners do not own assets. We just don't want to take a location risk. So example, in Houston, Ramiz and I, we bought a couple of 100 properties. So, I mean, we know every single block of the Houston. Sanjay, he bought over 50 to 70 properties in Dallas area. He knows it. And all of our partners have assets in local areas. We always buy asset number 2, 3, and 4. We avoid any new learning in a new area unless someone knows about that property. And then last one is the project risk. And this is, the first one is the business plan execution risk. I'll talk about it. And the last one, that is almost like a taboo, but we talk heavily about, which is the GP team delivery risk. We look at the capacity, which is how much of a, do they have the caliber? Do they have the capacity? Are they available at all time when we need a project? Back to the point, we buy companies. If you buy a $20 million company, whoever is running it, they need to be full-time, right? You just can't run a $20 million company when we have a W-2 and you're working already 60 hours, where the same team will buy 3 more of those properties. They have a availability issue, they have a capacity issue, even there could be high caliber individuals, right, or team. That's that. So I'll walk you guys through in this case. So going back to the first thing, the market risk, this is where the finance kicks in. We track, so our philosophy has been, we look at the macro outlook to decide debt structure. Case in point, after April, after our first asset that we bought, we decided not to buy anything on a bridge debt. It was a full period for Massive. That puts us in a corner of not buying anything big and also buy anything on a recourse loan. So yes, we are the very handful of unique syndicators who would take recourse loan because we're in it for longer and we believe in our projects. So that's that. Now we are on top of the market cycle, and I'll talk a little bit more about it. So we are right now bullish on a bridge debt. And then we are extremely bearish on a loan assumption less than 7 years. I'll explain that to why. That's where the finance kicks in, right? We follow the Fed's rate. On the left side, you can see there's a meeting coming up 3 weeks from now, and there is a 61% chance, 50% points, 50 basis point will go up. So we keep an eye on it. So when we go into making an offer, if you get close to the December 14th timeline, we're not going to do an LOI. We're not going to send the PSA. We're going to put that after. So we reduce the issue with the going back and forth with the sellers and or brokers and or lenders, right? It's a little more tactical room. And also, as you can see on the right side, we are here. Rate is going up, and rate's going to stay, and it's going to come down after 2024. So this is where, and if you buy a project 5 years whole time, 2022, 27, I'm right here. So I can assume what's my exit rate is going to be. Because, everything is back solving. We buy an asset to sell. So we have to see at that point in time, how would the market, pay us? Based on that, we can create a value today. A little bit more longer view of it. So for us, again, when we followed the Fed's rate, it was three things that we have been tracking since April. Was the pace of rate increase, and so we need to understand what market that we pick, and then height of rate increase. Sorry, this will be. Oopsie. Let me go back. So it was three things. Sorry, I kind of had it the other one. We are tracking the price. One of the big reasons that we did not buy anything on a bridge debt because of the pace. We just didn't know how fast it's going to go up since April. So we went to fixed term. That helped us. 5 assets we have, lowest interest rate is 3.75, highest one is 6, all 30 years amortization, 10 years fixed. Hey, interest rate could go 10%. We have no issue with it, right? So we have fixed debt for almost all of 100% of our properties at this point in time. The other one, the height of rate increase, which is how high it's going to go. That is the biggest debate the Feds were talking about. I know we have our own emotional feelings about it, but if I listen to Feds, height of rates, we believe we're on the top portion of it. So maybe another hike, and that's about it. So it's going to go high, then it's going to hold it steady. And the duration of the increase rate. That means once you fix it, how long it's going to be stay. So we believe, from Massive perspective, we are higher for longer, at least for a year and a half. And another 50 to 75 basis points, that's your likelihood to go. We know we're extremely comfortable with the 50% increase, and 75 basis point maybe by January. But whatever we do by December, that is going to be likelihood they're very close to the peak for a long time. Again, we use that to decide our debt structure. And then the location risk, which is to look at the county zip code characteristics, we have our own understanding. So now I will get into this project. And the last one is the business plan and the GP team. I'll talk about it. So on the GP team, just to let you know, for us, while we take a look at it, it's fun. We love the excitement of the entrepreneurship. We love doing deals, but at the end of the day, it's a job. We are taking on a project for 5-7 years. We have a fiduciary duty of our LP investors. And so that means it's a job at the end of the day where we're having fun, but we must deliver whatever that we promise to deliver. And we break out GPs into 5 different buckets. And so it's very clear, very transparent that expectation is set for everybody who plays in the GP team. And also we test that at the end of the day. Do they have the caliber? That do they know how to, are they sharp enough to run a $20 million company? In this case, this is the $20 million asset. Do they have the time to run a $20 million company today? knowing they're going to buy 2 more end of the year. And do they have capacity, given the life, given the W-2, given the other businesses, given this, how that plays out. So we test everything to make sure that GP team is qualified to deliver the project that we're going to do. So let's get into underwriting. That'll be fun. So back to, so when we started this project, we knew rate is going to go up. So we decided to go with a bridge, with an agency debt. So it's our second priority. And then we got into the zip code. So the property that we looked at is this. It's called Wimbledon Apartments, has a 3.2, and it is tucked between 45 and 249. Now, historically, if you knowing what we know about Houston, up until about 3 years ago, the path of progress wasn't there. It was mostly 249 and 290 area. But given the price increase in the market, it's kind of made a turn. So the improvement of the quality of the money is flowing this way than that way. So it's going from a left to right. So we're seeing improvement of the 249 and 45 area started about 2019 or so. And before that, it wasn't as good as what we see. That means you will see some gentrification still happening as you kind of go, and they're surrounded by a lot of homes. So this is our understanding of that area. That location-wise, it is getting better. Champion Forest was a hot cake a decade ago. It's not anymore. It's 249 below. With that, we said, okay, at least we know the characteristics. People live in a home, good school districts. That's how we started. That's how we liked it. Then we tested that with just this map. So here it shows the median earning by block. So the property that we saw, the location was right here, which is right by the school. So if you can see, I have one apartment, 2 apartments, 3, 4, 5, 6. So one thing, this is the catch span of everything. That means you live in a house with a lot of swimming pools, nice area, good school. Now you come close to here, take a look at it. So by design, before we come in, looking at it, we knew it's a workforce location, and it's gonna be very, very highly competitive area. So the management has to be very, very strong. So when they walk into this property, we still come and take our property. So this is the location. We measured that heavily. So we want to have darker the green, better it is. We like to avoid the red areas, but sometimes we do it. So this is how it goes. As you know, $74,000, $78,000 is the median earning. So going in, we knew it's a good location where a lot of families, a lot of houses. So we're gonna find, and it's gonna be a workforce living. And so that's how we, went about it. And we know the demographics as well, and then also the income as well. One of the things also we like about it, right here, is 131,000. This one, 145,000. This one is 88,000. So one of the things we take a look at it, that surrounding areas are expensive as well. What it means is that whoever is renting here, for them to move out here will be tough. So typically they will come here knowing that those houses are nice, those families are great, they have higher earning power, that replies into the school, that cascades into the living quality of the of that property. So when we took a look at this property, we like the setup of it. Now, as you can see, 45 and the red area is pretty far away. It's not the next block. So overall, we knew what we have there, we're gonna have there. It's not gonna change much, but we like the setup of it. And that's how we came into getting into this asset. Okay. And then we got into underwriting. So what I'll do here, I'll give you an idea of how we underwrite in terms of a macro, and coming in and going out in terms of a debt perspective, and then what is the typical expectation on the return and the structure that we do. And then one of the reasons why we are not as bullish on this one, right? So the listing asking price was 19,320, but we thought that was crazy price, but fine, that's what they asked. What we underwrote at that point in time, 3 months ago, we knew that bridge debt is not gonna work. We knew coming in, it's gonna check a lot of boxes for a lot of people. So it's good, there are going to be a lot of competition. And the typical competitions are couple of people from, I mean, we have some groups from Jake and Gino community. Then we have a heavy competition from Lifestyle Unlimited and extremely heavy competition from Brad Samra's group, right? We got to know the competition. Within the competition, we'll have one category, which is their professional buyers. They've been there, done that. They know what the price is. They're not going to push the envelope too much because you want to be comfortable. Other extreme will be the new team, where I want to get my first deal, just like I want to buy my first house. I am going to push everything, right? So our position was, we're not going to compete with that category at all. We're going to be somewhere in the middle. So because we have a better appreciation about this area compared to the guys who are really, really comfortable. So we want to be closer to the new folks, but not going to push the envelope where it has to be X percent of rent growth, Y percent of cost reduction, and has to be on a Monday to make us profitable. So we underwrote that at 35% down, 4.6, 60 months IO. We have, our team has enough balance sheet to get full 5 years IO, 30 years amortization. On the exit perspective, it was a 5 years hold, right? There's no refi at all. We're going to hold it for 5 years. When we exit, it was 5.25. So in our mind, 5.5 to 5.25, that was the matter of debate. But going back to the outlook here, so we felt comfortable at 2025, 2026, we will be same, if not lower than we are coming in. So if we're coming in at a 4, I mean, around a 5, we should be able to sell at a 5 as well, being conservative. So we are comfortable with that. So that's how we started. Then we managed the project for 2 ways: overall project return and LP returns. So our goal is to get 17 IRR and about 5 to 7% and annualized return about 19 to 22%, depending on the project type, and equity multiple about 1.9 to 2.1x, depending on the market, right? So it is tough to get a 1.9. For initial pass, it didn't pass. So we kind of left it at that. And then also we took a look at it at 35%, how much of the equity that we need. So in this project, even though the offer was $19 million, hypothetically, we have to raise 50% of the equity. So one thing we really very strongly take a look at it, we call it ROE, return on effort. Just because we set out to do multifamily, it does not mean we're going to go upside down just to do the work, right? And take on a risk of a $10 million on a $20 million project at that project that doesn't meet our requirements, right? Putting all together, we made an offer around 17.5-ish, I believe, at that point in time, 108. That was getting closer to the numbers that we look for, right? That checks it out. But then when we talked about our team, we said, look, $9.5 million raise, it's a huge raise where the market is going south. And most of us are tied into the equity market. It doesn't quite make sense to put that much of equity at risk for a project that has barely 17% IRR. So we stopped there. And so that's how we went about it. And that's how we're comfortable about losing the deal. And we said, hey, this is where we at, and we come down. So at the end, I think the contract went in. I believe that was a new settle group who never raised $10 million yet. And then, we by design contract fell out, it's back on the market. But for now, where we at, we still believe $10 million raise on a $18 million deal is too much of a work to do to get $15 or $16 million. So, and that's one. And second thing is that seller is where they at. Our position is more you wait, interest rate goes up and your price goes down. So we're not going to put ourselves in the middle of it. So we're going to stay on the sideline. So broker asked a question about the LOI, we folded an LOI, and we left it at that. So that's how we came about this this property. And when we looked at the GP team, we have Al here. So Al was the asset manager. We bring in the balance sheet partner or the debt partner. We negotiate with the lender as a MassiveÂ, and MassiveÂ is going to be the secondary asset manager to provide the guidance to Al. And we're bringing we have a property management company that we interviewed, we liked, and they're working with us very closely. And the team perspective, 100% of the GP team, they're full-time real estate. So we are in it for longer, and we're in it without any shackles per se. So when I'm 45 minutes into it, I think I went extremely quick. So, hey, let's bring in the questions. I go from there. All right. So anyone? Cool. Okay. Jasmine, do you see any questions on the Q&A? Or somebody texted me 2 questions. Let me go.
I don't see any.
Okay.
Let me double check.
So I got a text. We're asking for CapEx. Okay. So on the CapEx, so a question was asked to me. It's that how do we calculate total equity reserves needed, right? So typically on the equity side, you have the down payment, then we have the reserves, and we have the CapEx, and those are by default, right? So for the CapEx, this is the part I'll talk about it. So we have 3 buckets. Where's my CapEx? We have external CapEx, which is that we call it. The CapEx doesn't have a direct impact to the rent, so it's like a dead weight. Money is gone without a value, but you need that to support the infrastructure, roof, HVAC systems, and plumbing, electrical, signage, what have you. Then the other one is the interior that has a direct correlation of your rent increase, and the other one is working capital. So depending on the macro outlook, working capital may go up and down. Debt reserve can go up and down. At the COVID time, everybody got hit by debt reserve, but not anymore. And so that's what it is. So that's how we take a look at it. And typically we'll have a buffer on the reserve CapEx. We have a construction management fee depending on the amount. Typically, if it's more than $1 million, we start plugging 5%. That means that we can hire somebody full time or hire someone who can execute on a $1 million CapEx in less than 12 months, right? And that's a dedicated focus that we go. It's not for us, it's for us to spend so that make sure the execution happens. So in this case, we had about $1.6 million of CapEx, $400,000 of reserve, put together about $1.9 million of total CapEx. And we kind of go through it. Cool. So, right, I have another question. Okay. The question, okay.
मला दिवसभर चेंजच पडेल. I was so irritated. कानातलं हरवलं म्हणून.
All right. So that's all I had. I know we have about 10 more minutes. So if you have any question, feel free to ask. I can talk about underwriting all day. It's fun for me. I like it. So. Okay. Yeah. Good question. So my tagline is, yes, we need help for everything, right? Let me explain why and how. Okay. So Colorado assets, we bought with the local partner. So if you're local partners, any local asset managers, or you want to strengthen your skill on the asset operations or asset management, and you have assets that you own already, now you're going to get the bolt-on acquisitions, please reach out to us. We'll be more than happy to sit down and see how we can partner up. So that's one way. So Colorado is a local market. We met him, Nirvan and us. We bought the Denver area, and we're buying more.
I said, don't give me that song, Mudlagi.
And the second one, same for the North Carolina market. Fantastic group of people. It's 2 gentlemen. We bought one, so they already had one. We bought the second one, which is the water's edge. Now the third one. So even though we started small, $3 million, $10 million, right now we're underwriting a property at $12 million. So we're going up. Georgia market, we partner with Think Multifamily, Mark Kenny and Ravi. So they already have more than 800 doors, and we're partnering on them to get into the Atlanta market, like the Macon market. So if you're a local operator, let us know. And if you are equity raisers, also let us know. We have deals coming up, and we should have deals all the time. So depending on your requirements, expectations, and happy to sit down and talk and see how we can work together. So Mike, yes, we need help all the time.
Sure, this is Al. Can you hear me okay?
Yes, sir.
Yeah, I just wanted to say a couple words about the engagement and I think some good tips. Engaging with the team was really smooth because it was clear expectation from the beginning, clear communication, who's gonna do what, and we decided to go all in on the deal to exercise that process and get to know the team more through working a deal. And once we've done that exercise, we started to work better together. And Massive team was a great help to get that process accelerated. So, as long as you know what you're doing and you know what you want out of it, and you share that with the team and see where you fit in the process, Massive team can plug in all the holes that you need, and you'll take it from there. But I would start with a deal that you're comfortable with or something that you're looking for, and engage the team and let that process kick off.
To add, we appreciate you letting us, because some of the conversation that we have, especially this one, this is extremely touchy, emotional, Philly conversation, and we are extremely comfortable having those uncomfortable conversations. So we appreciate you going through the process. Just like in the corporate world, as I was mentioning, we like the work, but it's a job at the end of the day, right? So having a role, expectation, clarity is very important, and we like to have that early. It's one of the things that we have in the Massive team. We don't partner for deals, right? We partner for the relationship, and if we don't see the relationship lasting over deal number 3, 4, and 5, chances are we're not going to do the deals. Monies are there to be made, but people are the one that we are bet on. So yeah, if we just need a deal for one deal, then probably we're not the good fit. But if you're looking for long-term partners, then we're here. Mike's is delayed. Okay. What else? Okay. So I think we're on time. I will stop sharing then. Jasmine?
Yeah, go ahead.
Oh, cool.
But I don't see any more questions. I don't know if anybody else has more questions. We have like 6 more minutes.
I could ask a question, I guess.
I
Did anybody got
comments?
what's up?
No, I was gonna say, anybody questions, comments, and what they like, what they don't like, what they want to see, what they don't want to see. But go ahead, Schreier.
No, that's fine. Same thing. So I'm curious if anybody is underwriting a debt and what kind of terms that they're getting.
I was working on a deal on a sub-market, a bridge loan. They wanted 9%. Had a heart attack.
Wow.
9.5 was my last one. I almost jumped. I was like, bring it on. Charge me 20. I don't know what else to tell you. 9.5. Like, imagine you're buying $1 million companies for that. Oh, well. What can we say, right, Trevor?
Yeah. I'll put my 2 cents in though. Massive's a great group. I'm honored just to be a fly on the wall at a bunch of meetings and things, and looking forward to doing deals. I know we will.
Sure, our last one I got is 6.8 agency floating. So as of last week.
Yeah.
Wow. Okay. Rob is asking, how do you feel Central Florida market? Okay, so I'll give a long-winded answer on this one. Our belief is that most of the constructions projects that's coming up, they're not going to be sustainable for next year, year and a half. So if someone has a construction project, they're about to get ready for a construction loan for next 1 to 2 quarters, economics not going to work. It has to be in a regular sense. So it has to be either phased out to the end of the year, or there has to be something that is not visible from the surface. So with that framework, we are bearish on land acquisition today, unless it's extremely opportunistic buy, which is a very core asset. But we are bullish on I would say rescue capital. That means some of the work has been done, some of the entitlement work has been done. It's okay to buy and go to sleep for 8 months, then come back out December and break the ground. That's why. And that's also, we believe that having during the downturn, I personally went to 3 downturns, went through Shell with the oil and gas downturn, what we call it. During a downturn, your balance sheet will save you. Who is lendable, and they will be saved. So your team's balance sheet is extremely important. I don't know how to say it, it's extremely important. Second thing is the liquidity. That's gonna get you ahead. So having cash on your hand, that's gonna be important, because when the downturn happens, it's all about the rescue. It's not about taking on a new project, go through the risking of the whole thing. It's all about the rescue. So with that note, we are stacking up our capital. We're starting our fund in about 2 weeks, and on that process has been kicked off. So we are leading with that. So we like the Florida market. We like the new development, but it has to be in a place where land has been purchased. Somebody has done the work already. We need the last push to get to the entitlement closely and push the closing as far as we can. That's all. And turnkey improvement, yeah. Large value add deal, fine. It's a good question, Rob. Thank you. Lev, you got a good rate, but it's 6.3. Business model of, so we buy land to do new development, and we also do value add Class C purchases across six markets. So that's the business model for Massive. And every single asset that we buy, we manage, we sit down with the asset manager. So we are the end of the street. We're not the fund of a fund. We are the asset managers for all but 1 properties that we have. Even though we partner together. In this case, for this project, Al, his entity partner with Massive, but again, us together is the asset management team, one as a whole. We're not just equity raiser for the project. We don't do that.
Hey, I was gonna say, yeah, on that 6.3, that's what I was talking to my banker yesterday, and he confirmed that it's still 6.3. That's what we were a little worried with the rate hike, but they said they're still holding at that 25% down, and I believe it was a 20-year amortization.
Is it recourse, non-recourse? That's the caveat.
Recourse, and I mean they're only doing, I think, like 6 months, maybe a year of interest only.
So we're the crazy set of people. We take recourse loan to buy apartments. Just saying. Welcome to the party, Lev.
Yeah, thanks. Excited.
Hey, Lev, you got some offers floating out there right now, don't you?
Offers for what? Oh yeah, for the LOI.
You got some offers floating out there, don't you? Some
Yes.
LOIs?
Yes, we should be hearing Friday, he said. We'll know something Friday. So I will keep you guys updated.
And Mike is working his cell phones and texts to get a big one cooking. And hopefully Al is about to do his magic tomorrow and day after. Hopefully next week we get another offer out. So, hey, this is shopping time. Have heart failures, underwrite that at a 9% interest rate, and make some offers. Okay, thank you, everybody. Really appreciate your time. I know it's middle of the week, and this is late at night, so thank you. And reach out to us, any one of us from the Massive team, if you have any questions, and would love to continue this conversation.
All right, guys. Thank you, everyone.
Thank you.